Thank you very much for coming along today for our panel on what people seem to already be calling the B word. After a summer of hearing about how Brexit means Brexit, we've heard a little bit more about it this week. Looks like we're heading for a hard Brexit with, in particular, restrictions on immigration. I'm delighted to be here today to talk about Brexit, all of its implications, including for real estate, with Gerard Lyons, the economist, Sir Howard Bernstein, Chief Executive of Manchester City Council, Mardi Mokrane of LaSalle Investment Management, and who are you again? Wenzel Hober, Chief Executive of Tuva, last but not least. Just to let you know that we will have a couple of polls that you can respond to later on in the session. There will be a URL that you can bring up on your phones to vote in our polls, so I hope everyone will do that. But I'd like to hand the floor now to Gerald, who will make our introductory speech. Thank you.
Well, good afternoon. It's a great pleasure to be here. Thank you to EXPO REAL for inviting me. What I'd like to do is focus on three areas. First, how we got to having the referendum. Second, what's the current situation? The Prime Minister of the UK has, in the last 4 days, outlined the current government stance. And then third and finally, I'll focus on the implications. The referendum almost happened by accident in the UK. The UK former Prime Minister David Cameron promised it ahead of last year's general election. He didn't expect to actually call a referendum. But then when he basically had to call a referendum, we had a ridiculous situation of the negotiation. The UK government asked for very little in the renegotiation with the EU. It got even less in return. Privately, the government at that time was disappointed that it did not get a opt-out for the non-Euro countries over the Eurozone, but publicly the key focus was on the whole migrant issue. As a result, the referendum campaign was called. It was a 4-month-long referendum campaign, and I'm assuming not everyone in the room is from the UK, hence I'm just taking a bit of time to explain this. The turnout was the highest turnout for any election in Britain since 1997, and it was the largest number of people ever to vote for anything in Britain, 17.2 million. It did, however, show that the country was divided in many different ways, by age, by region, by city versus rural area. But it was a 52% vote to leave, 48% to remain. As a result, the focus after the referendum really was on why people voted the way they did. And what happened during the 3 to 4 months of the campaign was reflected in the post-referendum analysis, that 3 issues dominated. First, the most important was sovereignty, i.e. who runs Britain. Second was seen as being migration. Some people naturally were maybe against any migration, but overall the focus was on the need for some controlled migration, given that Britain has had the biggest ever increase in its population in the last 5 years, and it's never really been debated publicly or certainly politically. And the third issue was the economy. At the beginning of the campaign, the Remain side was 26 points ahead on the economy. On referendum day, they were 1 point ahead on the economy. The economy was seen largely as a neutral issue overall by election or referendum day. Sovereignty and migration dominated. And really what it highlighted was 2 big issues: the need for a new domestic agenda in Britain, and also the need for Britain to renegotiate, as it left the EU, its future relationship with the rest of the European Union. What's happened since? Well, first and foremost, the economy did not collapse in the way in which the previous government and Treasury forecast. Financial Armageddon was predicted. It was predicted beforehand that interest rates would rise, that mortgage rates would rise. The economy, after an initial fall in confidence, has actually seen a whole host of positive economic figures. And this is important for 2 reasons. Because it's starting to show that the public is becoming more accepting of the fact that we're leaving. And also, as was seen in the last 4 days at the annual Conservative Party conference, the fact that the economy has done relatively well in the last 3 months has given further wind to the sails of the Brexit campaign. Of course, you might say it's early days, and indeed, Judith's paper, the Financial Times, keeps saying despite Brexit. So some people naturally are saying it's too early to judge. But the fact that the economy has done well does actually significantly influence the balance of how the debate is progressing in the UK. In terms of the markets and monetary policy, we've seen obviously significant effects. The Bank of England prepared very well for the referendum. Unlike the previous Chancellor and previous Prime Minister, George Osborne and David Cameron, they basically did not prepare Whitehall at all. Whitehall did not do any preparatory work in case there was a leave vote. In contrast, the Bank of England did. I saw the governor last week, and what he was saying publicly last week is that the Bank of England had calculated that the city was only attaching a 10% probability to a leave vote. So the Bank of England did a lot of work to ensure that the city was prepared for the possibility of a leave vote. And therefore, the city, the financial markets, even though we saw big movements in equities and in currencies, the city and the banking sector was relatively resilient and was able to cope with the shock. Also, as a result, the day after the referendum, the Bank of England continued on its previous policy of easing monetary policy significantly. Interest rates fell 1/4 point. That is expected to add £5 billion spending to the economy over the next year. And as the governor has indicated, the Bank of England still has a bias to ease further. The Bank of England has indicated that it will not go to negative interest rates, it will not go to helicopter money, but it will continue with quantitative easing and a cheap money or low interest rate policy. Equity markets have hit close to all-time highs, but the currency markets saw sterling fall sharply. Sterling's probably at a 3-year low against the euro, a 31-year low against the dollar. But in the 40 years when Britain was in the EU, or since it's been in the EU, we've seen big currency fluctuations before. Sterling over the last 4 decades has gone from parity against the dollar up to 240. And it should be said, and in my opinion, I very much share this view, that sterling looked very overvalued before the referendum, given that Britain had a current account deficit of over 7% of GDP. But certainly the currency has fallen significantly, and even though it might have fallen to very attractive levels, there's no indication that the central bank is going to intervene, and there's no indication of any change in the political uncertainty in the next couple of years. So the markets are likely to maybe keep sterling weak or even push it weaker. There has been a significant shift in other areas of economic thinking in the UK. One of the main issues from the last 4 days at the Conservative Party conference is that those people who voted to leave should be rewarded and not penalised. What we've seen in the last 15 years in the UK is a combination of factors. London's dominance relative to other cities in the UK has widened. In fact, as the Chancellor of the Exchequer pointed out on Monday, the gap between London and the 2nd, 3rd, 4th cities in the UK in terms of productivity is bigger than in any other Western economy. Hence, the government is likely to focus very significantly on devolving power and boosting infrastructure spending across the country. Its hands, though, are still tied because Britain has a budget deficit. The other shift is likely to be seen in terms of migration. Britain has seen big increase in migration in recent years, particularly of both skilled and unskilled workers. Now, for unskilled workers in the UK who voted very heavily to leave, 2 things have happened as a result of that big increase in migration over the last 15 years. One has been that unskilled wages have been suppressed in Britain, and the other has been that British companies have cut their spending on training and skilling their workforce considerably. Indeed, if you think of it, someone running a firm could just pluck a Polish worker, maybe from Eastern Europe, could take in skilled or unskilled workers relatively easily. So we've seen not only unskilled wages remaining low, but lack of spending on upskilling the human capital. That is going to have to change. And then on top of that, this week, we got further evidence of the political process. Article 50 is going to be invoked by next March at the latest. That means, if you take Article 50 as being a 2-year process, the UK government is planning to have left the European Union by spring of 2019. We, in theory, have a fixed-term parliament in the UK, so the next general election is expected to be in May 2020. So the desire is to have this addressed before the next election. Of course, there's a few big buts here. The domestic politics is still potentially volatile in the UK. There is a legal challenge to the government invoking Article 50. That is expected to be cleared early part of next year. The government only has a small majority in the House of Commons, so there could be a challenge to Article 50, but I don't think there will be one. And then the House of Lords has a big anti-government majority, and they could yet block this, although it's expected that they won't. But that political uncertainty may weigh on the currency markets, may force the Bank of England to keep interest rates low, and actually adds to the uncertainty in the near term. But what it also means is that we need to see the government actually expressing a bit more certainty about the process in terms of its future negotiation. And this leads on to the final part, what I think is going to happen. The best way to think about this is that 3 into 2 does not go easily. There are 3 big issues. Sovereignty, which is the return of lawmaking from Brussels to London. There's migration. The idea is to limit migration, not no migration, but low migration. And then there's the economic issue of access to the single market. The debate in Britain in recent weeks has been whether there should be a hard Brexit or a soft Brexit. No one really knows what either means, but it's really, in my mind, a clean Brexit or a messy Brexit. A clean break or a messy break. A clean Brexit means the UK will focus on sovereignty and migration and will be outside the single market. A messy Brexit is where the government tries to be in the single market and has to give up something on migration control and give up something on sovereignty. This week in Birmingham, the Prime Minister indicated in terms of giving up on sovereignty. How will this impact the economy, and how will this impact your real estate sector, for instance, in the UK? It's important to stress that if the UK is outside the single market, it has a neutral impact on large parts of the country, a positive impact on some bits of it, and a negative impact on 1 or 2 sectors. The service sector never worked properly in the single market. Many small and medium-sized firms in the UK, if you listen to what they say they would be happy to be outside the single market and freed from EU regulations. If we do not do a deal with the EU and we're outside the single market, the tariff rate for industrial goods is about 3%. The tariff rate for autos is about 9.6%. And then there are some parts of the banking sector, particularly the American investment banks, Swiss investment banks, Japanese investment banks, who focus on passporting and may move some, but not much of their business to the continent. What I expect to happen is this, that the UK will work over the next 2 years on what it can control itself, which is a default position of having a clean Brexit. Then on top of that, the UK will try and have some sort of deal/relationship with the rest of the EU. The challenge, of course, is that that could end in many different roadblocks because you depend on 26 or 27 other countries as well as the Commission. Having the clean Brexit means that at the end of the 2-year process, Britain will leave. The expectation will be that the City of London will remain the financial centre of Europe, and we can discuss that in more detail. But at the same time, there is a desire expressed in Birmingham this week to maybe have a transition process to ease the issue in terms of, rather than having a complete break for the city, have some sort of smooth transition, because 1 or 2 European countries like that want that. At the same time, Britain has already started to have trade negotiations with a number of non-EU countries. It's allowed to do that, but no deals naturally can be done until the end of the process. The economy, though, depends on the outcome and the interaction between the economic fundamentals, policy and confidence. The fundamentals in the UK are mixed. The Bank of England is focusing on the commercial property sector. The UK has a twin deficit problem of a budget deficit and the current account deficit. And at the same time, there are other areas of the economy which look like they might be slowing down anyway. Policy, therefore, becomes key. Monetary and fiscal policy are likely to be very stimulative, so as a result, growth is likely to remain steady over the next couple of years. And the key issue is what happens to confidence. Fundamentals, policy and confidence is about retaining the confidence of both the domestic companies as well as international investors as well. Hopefully, I've just finished my 15 minutes, but bringing it all together, first, how we got to where we are was a consequence of domestic economic politics. Second, the UK government has explained this week that it intends to trigger Article 50 by at least spring of next year. And how I think things will go is that they will have to have a default position of a clean Brexit and then try on top of that to have a bespoke arrangement to do some sort of relationship in the one or two areas where they are focusing. Thank you for your time.
Thank you very much, Gerard. I think we have an opportunity now for you guys to vote in some polls. I'm just looking at the technicians at the back to see if they're able to gear that up for us. We've just got 2 questions, so it should be quite straightforward. Actually, while they're getting ready for that, let's just, if I could, go round to each member of the panel, let each person have their say, and I'd like to hear that in the form of talking about winners and losers from Brexit, who you think will be in each of those categories. Howard, would you like to start us off?
I have to congratulate Gerard, actually, because he's a well-known exiteer, but he's given a reasonably balanced analysis. I think the first point is it was a failure of the political class, both in the UK and in Europe, that we were in this position. A failure on our part to even have the referendum, but because that was the outcome of a debate with the Conservative Party, and a failure of the European institutions for recognising there was a need to reform. Because I think many of the views which have been expressed by the British people are actually not too dissimilar from many of the views that would be expressed in other European countries as well, particularly the issue around immigration. That's the first point. The second point I would make is I've still not heard a very clear analysis about how Brexit is to be achieved. I certainly never heard it from any of our senior ministers over the last few days at their party conference. So therefore, the uncertainty around what Brexit actually means is going to continue for some time. I get the argument about sovereignty, but I think that is pretty marginal conversation, particularly when you know that the first thing we're going to do is pass a law in the UK which actually ensures that every EU law and regulation actually becomes UK law. So the whole question of sovereignty seems a little esoteric to me. I think the fundamentals here are really about 2 things. One, a recognition that for too long, and I agree with Gerard and I have been on the same side on this for a very long time, that the approach we've taken in the UK to the delivery of national models is flawed, because it ensures that people who have not been connected to growth for a long time remain disconnected from growth, and therefore the argument in favour of devolution becomes even stronger. And I think the second issue is this must not become or remain a debate just within the Conservative Party. There needs to be an informed assessment about about what the different options are about Britain securing withdrawal from the European Union, what the impacts sectorally, what the impacts spatially in relation to different strategies around trade and investment. So we're clear about which way we want to go, rather than listening to people who base their views more on intuition than on evidence. And there is too much at stake here. One final point, the case for collaboration between cities in Europe and beyond, the case for collaboration with businesses in Europe and beyond has never ever been stronger. And I know this is also a very strong point on London as well. We have to redouble our efforts. We have to try even harder in the context of developing those strong internationally based strategies so remain outward facing and meeting the needs of business and the people who live there.
Okay, so we manage about £12 billion worth of real estate assets across a number of property types in the UK. So the way we look at this, of course, is, what's going to happen with our tenant base, what's going to happen within the occupier market, and, you asked a question about the winners and losers. So clearly, for domestic investors, for many of them, nothing much has changed, with one exception, which is looking at, where do you position your portfolio within the risk spectrum. Clearly, with so much uncertainty in the air, looking at the occupier, how do you make a decision today if you're going to take lease space in the city or elsewhere, if you're a retailer and if your cost base is in foreign currency and your income is in pounds, and you've just had a 15-17% drop in the currency. That makes life very difficult for retailers. But similarly, if you look at corporate occupiers, today, for the last 100 days, we've seen them asking for more flexibility. We've seen them asking for probably options to break leases, whereas they probably were looking at very long lease decision making. So we have to accommodate that. So we're thrown into a world of uncertainty. We don't know if we should anchor our beliefs on last weekend's discussions at a political level or next weekend's, and we just have to live with that uncertainty. For the real estate asset class in the UK, with bond yields at having halved or more than halved, we're not that worried about the pricing in terms of yields. We're more worried about the sustainability of income and the rental dynamics. One of the good things is that the economy came into this referendum relatively strong, probably one of the strongest in the OECD. Amongst the OECD countries. So that momentum has kept up. A lot of what we are observing from a deal-making perspective and from a leasing perspective were actually things that were already in discussion before the referendum. The key thing now is to look at, what happens next. What's the new generation, I would call them generation of tenants, post-Brexit? How are they going to behave? How are they looking at, taking up space and, taking on, leasing for a number of years? So clearly, our main concern today is on the occupier. For the moment, things are going well. I'll just share one statistic with you. We manage 2.2 million square feet of office space in central London. We've just had one leasing deal fall out in a direct relation to Brexit. That's fine, but again, we're very mindful of what this could change very quickly as we look ahead.
I would like to keep it short. I really liked your summary. I think it was slightly biased, but more or less balanced. But I'd say the winners are few people who actually had a political agenda. I think the losers are actually on both sides of the channel and across the board. I think we are all losing because uncertainty increases, and that might create some benefits for investors like ourselves, here or there. But overall, as European Union members, citizens, I think we're all losing, whether we are in the UK or in Europe.
Thank you very much, Wenzel. Thank you, everyone. I think we might be ready to do a poll. So I hope everyone has your phones out. And if you don't personally invest money, then for the purposes of this exercise, just pretend you do. If you go to the URL just up here, has Brexit made you more or less likely to invest in the UK? Oh, we're on exactly 50-50. That should even out then. Anyone else voting? Okay, we're right in the middle there. And we have a second question for you. Will Brexit benefit other countries in Europe? Yes or no? Okay, phones out. Well done, everyone. Oh no. So a majority here, potentially on the lose-lose side. Although, of course, you may all think that it'll bring huge benefits to the UK. So we haven't asked you that question. Okay, just to pick up on some of the points that people have been making, it seems pretty clear that the UK economy will be pretty drastically restructured in the coming years. And Howard, you mentioned including some of the people who've so far been excluded from growth. I just wondered if you had ideas about how that may be done or how that could be done and what the broader knock-on implications might be.
I think if you actually look at levels of worklessness, you look at the levels of low pay, you look at how people are disconnected effectively from the labour market. You know, in many of the big cities in the UK and in other parts of Europe, we see levels of disconnection which are as strong today as they have been 10, 15, 20 years ago. And the reason why that is because we don't deliver the relevant public services to support those people to get into the labour market, to take more responsibility for their own health and well-being. And that the case for the devolution of key programs and key functions to those places who are competent to deliver those programs more effectively has, in my view, never, ever been stronger. That devolution process was begun 2 or 3 years ago. Manchester and London have been some of the principal beneficiaries of that process, but we need to go further and deeper more quickly in order that we can develop and tailor skill programs to suit the jobs that we are creating. We can develop health and social care services to support people to actually get into work. The list is almost endless, and this needs to become an increasing part of a debate in order to ensure that still the most overly centralised model of decision-making to be found anywhere in the Western Hemisphere is systematically dismantled over the coming years.
And just to follow up to that as well, there seems to be an assumption on the part of government at the moment that reducing migration from Europe will incentivise companies to train more British young people to fill that gap. And I wondered, perhaps, Gerard, do you think it's as simple as that, and do you think there could be a sort of interim shock to the economy while we adjust in that respect?
Yeah, well, I think Brexit, contrary to the economic consensus, will be very positive for the UK economy, but there will be a transition phase because of all the uncertainty. In terms of your direct question, I think it would take a while for skill level and training issues to be turned around. And it's not a case of migration necessarily stopping overnight. There's big different regional dynamics. In terms of the economy, we also need to differentiate between London and other cities. London is likely to remain a dynamic global city. It's difficult to see London losing out as a financial centre. Indeed, London, if you speak to people in the city, they still talk about London's competition being New York, Singapore, Hong Kong. The head of the London Stock Exchange 2 weeks ago said if euro clearing moves from London, it will move to New York, not to anywhere else. Basically, Paris is not seen as a place to move to, the regulatory environment. Frankfurt, people just don't want to do it. Dublin, back office stuff goes there. People might move small bits of trading desks, etc. So if London remains dynamic, then other cities in the UK are likely to benefit from the changed emphasis in the UK. And also there's certain sectors, the life science sector, which was before the vote very pro-Remain, has almost had a sea change. People have now started to realise the easing in the regulatory environment will benefit it, and the fintech sector will be very positive. But coming back to your question on the skills and training, that will still take a lot longer to turn around.
And if we could turn now to Wenzel, you've actually, your company has bought a building in Edinburgh and a building in London, I believe, since the Brexit vote. So we asked you all if it made you more or less likely, but Triodos is putting their money where their mouths were, as it were. Could you tell us a bit about the logic behind those decisions and whether you think Brexit presents a buying opportunity?
Well, I think, as I said before, there are individual opportunities where you might benefit from uncertainty, and I think one of the opportunities we had was we have national European investors who are mostly based in Eurozone, and for them, of course, to buy at discounted exchange rates in a uncertain environment, where as a buyer you have a bit more power in the deal making, just gave us some attractive opportunities to buy at a good price. That doesn't, that helped us sometimes, but we also lost some other deals from people who did not want to sell because the environment was uncertain. And there are some other people who are not willing to make a decision because of the uncertainty, and that will not help our business. So I think, as always, there are some good and some bad sides to it. I think we've benefited a little bit, but I think what really drove our decision here was probably more individual to those investors rather than a general, opportunity. And I think a lot of this opportunity that opened up, where open-ended funds had to liquidate, or where uncertainty was, maybe a lot of this will just fade away. I do believe that the uncertainty will ripple out. I think we'll all settle, to a more stable environment in maybe 2 years, maybe 3 years. But I just wonder who is helped by this Brexit. I mean, this is all, there's some. I don't think the effect is going to be as negative as people fear. But why do we do all this? I mean, we have enough uncertainty as we were. We had immigration coming to Europe, we have terrorism, we have globalization, we have these social disconnected issues. We have them anyhow, and the Brexit also doesn't help or does not give anybody a solution to it. So from my perspective, it's just adding another obstacle to everybody's lives.
If I could come back, and I think one of the big issues is that Western Europe really needs to wake up to how the world's changing. There's a shift in the balance of power. The innovative region of the world is the Indo-Pacific region, India, China, the US. And one of the big issues in the campaign was about the need to change. And the timing of the referendum was bad, and the previous Prime Minister called the referendum for domestic political reasons. But in the end, the referendum was called when it was. And a vote to remain in was seen by many people as not a vote for the status quo. A vote to remain in was seen as really tying us more in the future to a European project that in the UK we felt had to become a political project. In the renegotiation, the French and the Germans would not give Britain an opt-out for the non-Euro countries over the Euro countries. That meant any area of disagreement would be decided by the European Court of Justice. So it's fed directly into the sovereignty issue in the UK, but it also highlighted that the survival of the euro was key to the European project. And it probably will mean Germany has to have bigger fiscal bailouts to the periphery. It means the periphery of Europe has to buy in more to German economic thinking. But in the UK, certainly the City of London and other parts were a bit cautious that remaining in was not a vote for the status quo. So I think, coming back to your question, it pulls Britain away in some people's eyes from something we're not confident about. But at the same time, it now forces Britain to address some of its own structural issues, as well as maybe seize the opportunity in infrastructure and regional issues. And basically, lots of people have not shared in the success, and they need to be addressed head on. So it's a complex one, but I think after the initial transition, there's the opportunity. Of course, we need to seize the opportunity.
Just to echo, sorry, just one word, a couple of observations for us. As as you can see, the debate, points to two things, uncertainty and complexity. Obviously this has become a more complex, more, uncertain place to invest. And as I said, when we discussed with international investors looking at Europe today as a relative sort of attractive investment destination compared to sort of North America, which is, one of the largest, real estate investment pools, and Asia Pacific, which has its own sort of issues. Today, Europe has become, investors look at this in two ways. They would actually either say, well, you guys need rescue capital. You're going to dislocate. And I think there is something we should talk about, which is the implications for the rest of Europe of the Brexit vote and the upcoming sort of string of elections we're going to have in the rest of Europe. That's something that we're very mindful of. And the other point is any investor looking at deploying capital in this region, which has a domestic currency, will have to think about hedging, and hedging has become tremendously expensive today, and that's something that probably will deter some of the capital that wouldn't have naturally come to this region, and in the UK in particular, probably pausing or saying maybe I'll accept a lower return in my domestic market and not invest in Europe. Let's see how it pans out. Let's see when the dust settles.
Howard, if I could ask you here, you've been pretty instrumental in bringing a lot of international investment into the Manchester area. How are the overseas investors that you speak to reacting? Are they also waiting for the dust to settle?
I think it's varied. There are some examples of European and North American investors who are being very, very cautious, not saying no, but as saying, well, let's go away and reflect and think again. Whereas in Asia, we're still seeing very strong interest and, turning, deals over quite quickly because they tend to think long term, and notwithstanding all the uncertainty, some of the primary requirements around international investment, the rule of law, stability of leadership and governance, etc., is still seen to be a prerequisite in making decisions around investment. And I think the most important thing is we're going to know a lot more in the middle of next year when we actually see what we're trying to negotiate. At the moment, we haven't really got a clear view of what we're trying to negotiate, and that's when I believe we'll be in a much stronger position to assess the overall financial and economic impacts of what our strategies are taking us forward.
Can I make just one little comment? If you look at the middle of next year, and we discussed this at our investment committee and strategy committees, the middle of next year is just between the French election and the German election. So I think, we're going to have to live with this huge uncertainty for an extended period of time. So, we'll be taking different views depending on, the outcome of those elections.
And just to pick up on something you said slightly earlier, Mardi, you mentioned the potential effects on other European countries of Brexit. Would anyone like to weigh in on how significant you think that might be, and how it might change or even slow down the European project?
I personally think what we are witnessing is not the first major disruption to the European project, however we view it. I was a very strong proponent of staying in the European Union. I think most serious people that I know actually agreed with that analysis. But at the end of the day, the European project, in its broadest terms, needed to recognise the priorities of ordinary people, and no one can say to me that certainly the arrangement that was brought back by the former Prime Minister from those European negotiations accurately or fairly reflected the concerns not only of people in the UK, I suspect a lot of people elsewhere in Europe. And what we're going to see, I think, over the next 6 months, particularly with the German and French elections, is a greater understanding of where the balance amongst ordinary voters actually lies about what the priorities of the European project will be. And I do not think we should exclude that from being an influence on how that will inform what the future strategy of Brexit, where the UK is concerned, will be.
I think, so far, we've all seen it as a theoretical exercise for somebody exiting the European Union, also exiting the euro, as we had a couple years before that. So I think most of us thought, well, maybe, but it's not going to happen. And after the Brexit, I was initially very worried that maybe Denmark, Holland, Austria could be next on the list. And I think some of the investors were as well. I think everybody has kind of reconsidered, and maybe that risk is lower now given what people have experienced since. But I think given that this one process has started, I think now it's always in the realm of possibilities, and therefore that could kind of spread out to other political referendums. It could spread out to people being thrown out of currency, and again this could create a whole kind of a whole basket of other risks coming towards us that we all thought were out of the possible range. And I think that's the main danger. I don't think the next country will come very soon. I think everybody will look at, how it goes. But it's not a theoretical exercise anymore, and I think that's the main danger.
Gerard, did you want to respond to that at all?
Yeah, well, I think it'll be interesting to see how people in Germany react, not just because of the big increase in migration last year, but Germany actually did probably quite well having 1 million middle-class Syrians come into the country. So in terms of the quality of the people who come in is an issue. But how that plays out domestically is one issue. But in economic terms, the European Central Bank effectively has to become the shock absorber, or is still, you might say, is already the shock absorber. The European Central Bank probably will have to continue down the path of easy money, which doesn't go down well within Germany. The pressure around the rest of Europe, when I go around rest of Western Europe, is the pressure is for Germany and the Netherlands in particular to spend more, to actually spend some of their big surpluses. So there are big economic tensions. But I agreed with what Howard said earlier, but one of the issues at the beginning of the renegotiation last year was at that time a number of Eastern European countries, Netherlands, Portugal, there was one or two others, Sweden as well, were reaching out to Britain to actually argue for Britain to push for reform where power went from Brussels back to national parliaments. Unfortunately, the former Prime Minister didn't seize that opportunity. So instead of going with an EU-wide type of reform, he came with a very UK-specific reform and missed the big opportunity, I feel. But that issue that was very evident then is still an issue about the relationship between Brussels and different national parliaments, and that needs to be addressed because Brussels, in my view, is completely out of touch with what's going on the ground in so many countries.
I can see you nodding there, Howard, so it's good to see a lot of points of agreement between you two. I'm just wondering if we have any questions from the audience. I've got a huge list here, but you may have some too. Do you want to raise your hand if you have a question? Yes, gentleman in the middle here.
Mark Thomas from Aramark. My question is really, I think, first to you, Dr. Lyons. You say that so far we haven't seen any impact, that the economic indices have not gone down, but really nothing has happened yet. I mean, the UK is still in the EU, it's still paying its dues. I mean, nothing has happened. But if you really look in some of the micro trends, I think there are some things where the investments into the UK have gone down. I think companies have stopped hiring or started thinking about the hiring. So I think those trends are they're not evident yet, but I think they probably will become evident. So that's sort of the first point. The second one is the part that astounded me the most, I mean, listening to a lot of the Brexit and a lot of the arguments, is that there was no plan on what do we do and where are we going to, what do we want to do with this whole thing. And we're sitting here still half a year later, and probably be sitting here 2 years later, still thinking about what are we going to do. And I think that's the part which, and I really agree, with Mr. Hoberg, is that will create such a huge amount of issues throughout the whole Europe, which will decrease the European growth trends, which will then have a major impact, a secondary impact on the UK as well. And there's no way we're going to be able to get back out of this hole. So maybe the UK, after 3 or 4 or 5 years, finally gets back on its feet again. But the decrease will be so big that it's going to take a lifetime until we get back into where we were, a year ago.
Okay, thanks for the question. The two different parts of the question. The first, you were saying nothing's happened yet. What you have to remember is the official government forecast was that if the country voted to leave, and even without triggering Article 50, unemployment would rise by 500,000 within a year. Every major forecasting firm in the city said even with a leave vote and even without Article 50 being triggered, the economy would collapse in the last 6 months of this year. All of those forecasts have been revised up. All that's happened, but I'm saying that's the reality. So they were all very public about that. So in terms of relative to the forecast, in terms of what I would expect, investment plans will take some sort of hit because of the uncertainty. Although, as Howard touched on, we are seeing investment coming in different sectors from different regions, and it depends on the business model. But generally speaking, there will be some uncertainty in the near term. Has to be said, business investment in the UK has been 2.5% below the trend in recent years anyway, even before Brexit. And the UK, 7 years into recovery, has been at the stage of the cycle where in the past it would slow down. In terms of you're saying no plan, the reality is that the Leave side was not a political party. They didn't therefore have a manifesto, but they did actually have lots of plans. But it's up to the government to actually implement the plans. But in a nutshell, if you wanted to put that in a manifesto, it was to trigger Article 50, to leave, and either leave with free trade or WTO trade as the basis, which would worry German auto industry because that would mean that the UK will cut import tariffs on cars into the UK. American cars would not face the 9.6% tariff that they face selling into the EU. So to cut that, but on top of that, a bespoke deal. Also at the same time, very much a focus on the regional agenda as well. So going back to your question, it's a valid question because it's been said, but the Leave side was not a political party. A referendum basically was around the whole host of different people, across different parts of the political spectrum. But what we've seen this week from the government in Birmingham is basically that plan as such starting to finally be announced. Thank you.
Thank you. Any more questions from out there?
Maybe I can ask a question because I'm really curious whether Scotland will have another vote or not. And we talked about it, in the back room a little bit. But can you give me your views on whether we'll have another vote and maybe which way it could go?
Yeah, there are really three issues here. One, the domestic political pressure in Scotland from the SNP, Scottish National Party, is for them to have a vote sooner rather than later. Second, though, the regional environment within Western Europe is working against that, largely because of the fears that if Scotland ceded, then different parts of Spain might want to cede. So the European Commission or Brussels has not been, shall we say, warm towards Scotland. But then the third issue is that whereas people in Britain, when they voted, probably didn't feel they had a good deal from Brussels and a good relationship, many people in Scotland actually feel that they might not like the politics, but they feel that their economic relationship with the UK is a good one. So the perception is that even if it went to a vote, it's by no means clear-cut that Scotland would vote for independence. But there are different offsetting pressures. But that domestic political pressure in Scotland might be difficult for them to resist. But we'll see how it turns out.
I personally think it's inevitable that there will be a referendum in Scotland. I think the issue is when. I think one of the reasons why it's not likely to be sooner rather than later is because I don't think the economic environment actually would suit that vote and those who want to leave the UK. But I think over the next couple of years, I'd be very surprised if there wasn't a vote to leave, and more particularly, it will result in the split of the UK. I've got no doubt at all about that. That's if that referendum does take place, I'm convinced that's what the outcome will be.
Oh, do we have another question? Just over here.
Hello, I'm Melville Rodriguez of CMS, a law firm. My question is directed at Dr. Lyles. It's this notion of the single market and its relationship with the UK, in particular focusing on real estate and real estate fund managers. In the press, a distinction has been made between the UK having a continuing membership of the single market as opposed to the UK having a continuing access to the single market. Could he comment on whether he sees the latter as a feasible solution going forward? And secondly, rather selfishly on the part of our real estate funds industry, when we talk about accessing the single market, the publicity in the press is on bankers and other industries, but could that also extend to fund managers, and in particular the real estate fund managers?
Thank you. In terms of the first point, yeah, if you take the three big issues, sovereignty, migration, single market, a clean Brexit, a clean break where you control sovereignty fully and you control migration fully is a clean break outside the single market. If you want to be in the single market, then it's almost like that Venn diagram if you're at school or university, if you remember the shapes and you have those three shapes, single market, migration and sovereignty, you then have to work out where those shapes will interact, and that will depend on the trade-off. Now, the challenge about being in the single market is that it depends on 27 other countries plus the Commission, so it's complex. Therefore, the logical approach for the UK is that in any negotiation, first you need to be prepared to walk away, and second, you need to keep the negotiation simple. So therefore, I think the first part should be a default Britain outside the single market, because that's under our control. But the second part of the process is that clearly different parts of the UK will want to be in the single market, the auto sector, parts of the city. Therefore, you try and do that sort of relationship type deal. And then that just does depend. If you go from the legal side, as I understand it, and there's always, if you have different opinions amongst economists, you seem to have even more opinions amongst legal people. But as I understand it, if Britain goes for a very simple type of free trade agreement, then it can be qualified majority voting, and hence the importance of the French and German elections becomes important. If it becomes anything more complex, it's everyone has to agree, which makes it very difficult. So I hope that answers it. The second part, I'm not sure about the real estate funds, but in terms of some of the other funds, UTIS, etc., is a big issue. You basically have the funds managed in London in some of the unit trusts and everything like that, but they are already legally based in Dublin and in Luxembourg, but I'm not sure if that happens in the real estate sector. But the point is, when you go across the city, there's different things across different sectors. The passporting issue, it also gets mixed up with the equivalence issue. If you think of a shelf, a bookshelf, with passporting as a bookend at one end and equivalence at another end, there are some firms whose business model is very attached to the passporting. Equivalence and regulatory equivalence comes in 2018, 2019 for third countries, and many other firms are not going to be impacted because they're at the equivalence end. But even when you talk, or as I used to be on the board of City UK last year, and we did a lot of work on this, but I'm not sure about the real estate funds, I'm sorry. But in terms of the other bits, again, it's not a case of firms moving lock, stock and barrel. It's a different business models. But the point also, slight tangent to this. The worry many people in the city had about remaining in was the declining ability of the UK to control the regulatory agenda within the financial sector within the EU, because the European Court of Justice was the final decider in areas of uncertainty, and the regulatory intrusion into different areas, pension funds being one example. And some people in the city felt that that would cramp the city's style in the international environment. So there may be trade-offs in this, that London eventually is able to position itself far more attractively internationally as a place to do business from. But in the near term, you need to work out the business model in terms of different parts of the city. Thank you.
Maybe I can answer the investment management question a little bit. I mean, I don't think passporting is going to be that relevant. I've seen a study from Pricewaterhouse where they thought, maybe 80,000 bankers could move to Frankfurt. Even if that would happen, it wouldn't be such a big impact. But I agree with you that, in the end, people will not move. Maybe some of the business will move over. I think the industry has operated before the EU. It's the cross-border business is happening today without a union across everything. So I think the business will continue. I actually see the city losing some jobs, maybe for regulatory reasons, but it will also gain a lot of jobs from the competition in Singapore and Switzerland and all these other havens of money, which will, the city will be able to attract other capital that could give it another growth driver. So I don't think the impact of this passporting is going to be that relevant. I think for a fund manager as an individual decision, it just means you need to be prepared. You might need to add cost, and that's happening with any regulatory step anyhow. So I think it will just lead to a further consolidation of global investment managers. But that's a general trend, and that's nothing to do with the Brexit, really.
I would add to that I think the funds industry has shown itself pretty adept at moving people between different jurisdictions in order to make the most of different regulations and tax regimes. And there is, of course, something we haven't covered is the possibility of additional tax breaks to incentivize some of these businesses to keep people in the UK.
Just one. I mean, what I'm hearing, if you think about decision-making processes within what we've just discussed, you can have, six economists and seven opinions, or 5 lawyers and 6 opinions. But clearly, in terms of decision-making, when we keep, touching base with our tenants, a lot of them actually have difficulty making long-term planning decisions. And one of the key attractiveness of the UK market, of course, is its size, its liquidity, its transparency, but also the ability to generate long leases with decent indexation. And that key feature of the UK market today, is going to be put under pressure. And that's one of the things that we have to take into account. And when you have to match your liabilities, real estate actually is a very good asset class, and we're all real estate people in this trade fair. And I think this is something that long leases, index leases will have more value. If you compare them to index-linked gilts and where the yields are going, not just in the UK but elsewhere, because post-Brexit bond yields have fallen across Europe, not just in the UK. So that's something we're deeply taking into account in our allocation decisions.
Thank you, and we're actually over our time, so I think we're going to have to draw that to a close there. Thank you so much for coming along to this session, especially when I know that there's beer on offer at many of the stands. We appreciate your sacrifice. Enjoy the rest of Expo. Thank you.